In high-stakes litigation, the financial implications of a verdict can be as complex as the legal battle itself. The following case study delves into a representative high-value case that resulted in a substantial $20 million verdict and showcased the critical importance of strategic financial planning in maximizing the plaintiff's recovery. The case at a glance. Our plaintiff, a reputable tax professional, found themselves at the center of a damaging defamation campaign. The defendant, a competitor, had knowingly and maliciously made false statements claiming that the plaintiff lacked the licenses to conduct their business legally. These allegations struck at the heart of the plaintiff's professional integrity and threatened to derail years of hard-earned success and a glowing reputation. The ensuing legal battle resulted in a judicial award for the plaintiff. The court rendered a verdict, awarding a staggering $20 million in damages, plus attorney fees and costs. This victory, while vindicating, brought with it a new challenge: navigating the complex tax implications of such a substantial award. The tax conundrum: punitive damages and contingency fees. Of the $20 million award, $10 million were punitive damages. While this substantial sum was a strong deterrent against future defamatory actions, it also presented a significant tax challenge. Under normal circumstances, the plaintiff and their attorneys would face hefty tax bills on this portion of the award. The crux of the issue lay in the taxation of contingency fees associated with punitive damages. Typically, these fees are taxable income to the plaintiff, even though they are paid directly to the attorney. This quirk in the tax code stems from Commissioner v. Banks, a case which was decided by the U.S. Supreme Court, addressing the issue of whether the portion of a settlement or judgment award paid to a plaintiff's attorney under a contingent fee agreement is taxable income to the plaintiff. Thus, the plaintiff will pay taxes on money they never received. This results in the need for an ingenious strategy. As a tax professional, our plaintiff knew about the complicated tax problems that would follow his victory. In preparation, he and his legal team planned an ingenious strategy. This strategy would utilize two separate tools: the 468B Qualified Settlement Fund and the Plaintiff Recovery Trust. By using them in conjunction, the plaintiff maximized his possible tax savings. But what is a 468B Qualified Settlement Fund? This financial tool, named after the Internal Revenue Code section that governs it, would prove invaluable in managing the settlement proceeds. The QSF acted as a temporary holding account for the award, providing several key advantages. 1. Time for planning. It allowed the plaintiff and their advisors breathing room to make informed decisions about the distribution of funds without immediate tax consequences. 2. Flexibility. The QSF provided options for structured settlements and other tax-efficient distribution methods. 3. Protection. During the planning phase, it shielded the funds from creditors and other potential claims and removed the defendant from creating additional problems. Using the QSF, the plaintiff's team laid the groundwork for a comprehensive financial strategy to maximize the net recovery from the verdict. However, it was doubly effective with its paired tool. Enter the Plaintiff Recovery Trust, a tax-saving innovation. In addition to the QSF, the plaintiff's financial advisors proposed utilizing the Plaintiff Recovery Trust, PRT, to address this looming tax burden. This specialized trust is designed to eliminate the taxation on the contingency fee portion of the punitive damages. How the QSF and PRT work together. Step 1. The plaintiff assigned their entire claim for damages to the PRT before the court's order or settlement. Step 2. The defendant paid funds into a QSF on behalf of the PRT. Step 3. The QSF then paid the contingency fees directly to the attorneys on behalf of the PRT. By designing the transaction this way, the plaintiff avoided recognizing the contingency fee as taxable income. This strategic move resulted in substantial tax savings for the plaintiff, ensuring their after-tax settlement proceeds were increased by $1,480,000. Financial implications, a closer look at the numbers. Let's break down the financial impact of using the QSF and PRT by looking at our plaintiff's potential tax liability without his strategy. Without strategic planning. Total award, $20 million, punitive damages portion, $10 million, contingency fee on punitive damages portion, assuming a 40% contingency arrangement, $4 million. Taxable income to plaintiff, $20 million, potential tax liability, assuming 37% federal rate, $7,400,000. Now let's look at the same numbers, this time while utilizing our plaintiff's ingenious strategy. With QSF and PRT, total award, $20 million. Punitive damages handled through PRT, $10 million. Contingency fee on punitive damages portion paid directly from PRT, $4 million. Taxable income to plaintiff, $16 million. Tax savings, $1,480,000. This simplified calculation demonstrates the significant financial benefit of employing these strategic tools. The final savings may be even more significant when considering state taxes and other factors. The intersection of law and finance. With its $20 million verdict, this defamation case serves as a reminder of the linked interrelationship between legal victories and tax outcomes. By leveraging paired tools like the 468B Qualified Settlement Fund and the Plaintiff Recovery Trust, the legal team was able to secure victory for their client and maximize justice by improving the financial benefits. For legal professionals, this case underscores the importance of holistic client advocacy. In an era of complex litigation and equally complex tax laws, the ability to navigate both legal and financial waters is invaluable. By staying informed about innovative financial solutions and collaborating with financial and tax experts, attorneys can provide a level of service that extends far beyond the courtroom, securing not just legal victories, but financial ones as well. The preceding case study is an amalgamation of identities and facts adapted to simplify and protect the privacy of the parties and cases. Some facts and circumstances have been changed for educational purposes.